welcome to another market update. We have lots to talk about today, but first of all, we've got the background for the KFA Club behind me for a reason. If you haven't already joined, make sure and do so. All right, today is March 31st. It's Friday. It is the end of Q1 of 2023. And today we got our February PCE report. And remember, friends, PCE is the preferred measurement that the Federal Reserve uses to measure inflation. Today's PCE report came in slightly better than expected, which is welcome news. Within that report, we also saw improvements in wage growth, as well as a reduction in spending by consumers. The lower PCE combined with the wage growth and personal spending improvements are all welcome signs that inflation is continuing to ease. In addition, the Fed went back and revised the figures that we had for January, which, if you recall, sent shockwaves through the industry and caused rates to spike for a period of time. Fast forward into March, we are now at the place where we're seeing the effects of all the Fed rate hikes starting to take hold. This chart we have here showing the PCE over the last year or so, you can see a discernible decrease from the high of 7% on the PCE report. So we're definitely heading in the right direction. It's not as quick as we want, but it never would be. It never will be. One of the things that we're going to be keeping a close eye on moving forward is the bank crisis that we've been hearing all about on the news. While I don't think we're actually in a full-blown banking crisis, what is going to come of this is tighter lending standards from the banks. As banks feel the stresses of the current economic situation, they start to pull back on how much they want to lend. They start to apply tighter lending standards, higher credit scores, larger down payments, things like that. Not just in the mortgage industry, but in all sectors. And so those things are going to have a deflationary effect that are probably going to be greater than any more Fed rate hikes. So the market is starting to price in the end of the hiking cycle. Whether that means one more hike or not remains to be seen. More reports like the one we got today will certainly lead us in a direction of potentially being done with rate hikes. With that said, the one thing I really want to focus on is the volatility that we've seen with the 10-year Treasury in particular. So for those of you that are lender friends, you know what I'm talking about. For the real estate agents out there, I want to explain this in a little more detail. Over the past few weeks, we've seen the 10-year Treasury whip up and down with large jumps and large drops, and it's created a lot of volatility. And when we have volatility like that, we tend to see mortgage companies and lenders sort of back up a little bit and say, we're going to wait and see how this plays out before we improve rates. And so while the 10-year Treasury has come down, we haven't seen rates improve to the same level yet. I think as the dust settles on the bank crisis and the dust settles on the recent Fed hikes, I think we'll start to see the volatility calm down. And when that occurs, that's when we should start to see some improvement in pricing. Not just in terms of interest rates, but also in terms of reducing the discount points that are being charged. As things start to calm down and rates settle a little bit, we should see the cost of rates come down as well. So those are all things that will help our buyers and all things that will help us get more people under contract. Thanks for watching. Be sure to like, subscribe, and share. And if you haven't already, join the KFA Club on Facebook. KFA.